Ladies and gentlemen, good day and welcome to Senores Pharmaceuticals Limited Q4 FY26 earnings conference call hosted by Ambit Capital. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gaurav Tinani from Ambit Capital. Thank you, and over to you, sir.
Yeah, thank you, Yusuf. Good evening, everyone. On behalf of Ambit Capital, we welcome you all on the Q4 and FY26 earnings conference call for Senores Pharmaceuticals Limited. Today on the call, we are joined by Mr. Swapnil Shah, the promoter and managing director, Mr. Sanjay Majmudar, the chairman, and Mr. Deval Shah, the chief financial officer of Senores Pharmaceuticals Limited. We will begin the call with opening remarks from the management, followed by a question and answer session. Thank you, and over to you, sir.
Yes, thank you, Gaurav. Good evening, everyone. Thank you for joining us on Senores Pharmaceuticals Limited Q4 and FY26 earnings conference call. We have uploaded our results, press release, and investor presentation on stock exchanges and company's website. Guided by our well-defined strategies and strong execution capabilities, we delivered a robust performance across segments during the quarter and throughout FY26. Our focus on operational discipline and consistent execution, along with sustained momentum in key growth areas and our diversified business verticals, enabled us to maintain healthy business performance despite an uncertain operating environment. The diversity of our business across verticals geographies provides tremendous resilience in challenging market conditions, but has also helped strengthen our overall performance. For FY26, we achieved approximately 62% revenue growth and 108% PAT growth over FY25, showcasing the strength of our business model and our execution excellence. Total revenue stands at about 663 crores with a profit of 122 crores. This clearly surpasses our guidance for the year. It is gratifying that even after 8 quarters after our IPO, we continue to deliver performance ahead of our stated commitments, despite an uncertain environment. This consistency reflects the credibility of our long-term strategy and the strong execution culture embedded across the organization. We remain optimistic about sustaining this momentum in the years to come. Our confidence is supported by a robust product pipeline, expanded manufacturing capacity, and a strengthened R&D infrastructure. Coupled with our proven ability to identify, develop, commercialize niche products in developed markets, as well as our deep understanding of market dynamics, we believe we will continue to outperform industry growth trends. In parallel, we have continued to diversify our product portfolio, geographic presence by strengthening our reach in emerging and domestic markets, thereby creating additional avenues for sustainable long-term growth. We are consciously building a balanced revenue mix to ensure that. Over the past 18 months, we have made significant investments in expanding our product basket, enhancing manufacturing R&D capacities, broadening our global footprint, onboarding experienced industry professionals across critical functions, which will fetch huge benefits in the future. With a strong foundation, differentiated capabilities, and a clear growth map, we are confident in our ability to continue delivering similar performance in FY27 and beyond. For FY27, our initial outlook indicates a revenue growth of approximate 30 to 40% and our PAT growth of about 50 to 60%. This confidence is supported by robust order pipeline and a clear visibility on upcoming product launches over the coming quarters. Speaking about the segmental performance, revenue from the regulated market registered a robust growth of 83%, YOY in FY26, driven by expansion of our product portfolio, prudent selection of sales channels, and differentiated go-to-market strategies. Our ANDA portfolio continues to strengthen through a combination of in-house development initiatives and strategic acquisitions. As of March 2026, we had a portfolio of 51 approved ANDAs, collectively covering more than 150 product strengths. Over the past year, our approved ANDA portfolio has more than doubled, increasing from 22 ANDAs in March 25 to 51 approved ANDAs in March 26, reflecting the scale and the pace of our execution. Out of approved product portfolio, 20 ANDAs have already been commercially launched, while an additional 30 approved ANDAs covering over 100 strengths will be launched over next few quarters. Beyond our approved product portfolio, we currently have over 27 molecules involving more than 60 strengths under various stages of development. This broad and differentiated product pipeline provides strong visibility for growth over next 24 months. Our team continues to identify evaluate products that strengthen our pipeline and provide sustainable growth visibility over years to come. Our CDMO-CMO segment is also witnessing steady momentum and growing traction. A key differentiator of this business lies in our ability to offer end-to-end solution to customers, spanning product development, scale-up, exhibit batch manufacturing, supply chain planning, commercial production, comprehensive regulatory support covering both pre- and post-approval requirements. Our CDMO business comprises of specialty, complex, and NDAs application with 505(b)(2)s and other differentiated formulation strategies. Our CMO business not only helps absorb a significant portion of our operating costs, but also drives large-scale volumes, thereby creating meaningful operating leverage for the company. In this segment, we partner with several marquee global and domestic peers, reinforcing confidence in our capabilities to consistently deliver high-quality products on time and with a competitive price. Speaking about recent developments, we acquired 75% stake in Upland Pharma in Q4 FY26, with the remaining 25% is expected by end of this year. The plant acquisition with its US FDA-approved manufacturing facility provides significant strategic advantages, establish a strong platform for long-term sustainable growth. The relatively new facility equipped with multiple pre-constructed clean rooms and expansion-ready infrastructure enhances our manufacturing capacity and operational flexibility, while India-based manufacturing enables cost efficiency. Additionally, the diversified manufacturing footprint strengthens scalability, accelerates product commercialization, and enhances our ability to pursue a broader range of CDMO-CMO opportunities across both facilities. Beyond the US, this facility is also approved by UKMHRA Health Canada, which enables immediately to leverage upon current existing approval in this market. We have already commenced products rollout from this facility. Revenue for this quarter from this facility was modest. However, we have already started significant commercials from this quarter onwards. In line with our strategy to deepen our presence in US market, we acquired Senores Pharmaceuticals as a step-down subsidiary in Q3 FY26, bolstering our marketing and distribution strength in the US. Senores manages full-cycle pharmaceutical commercialization with a partner team, bringing over a decade of sales and marketing experience and commercialization in the US. In April, we entered into a strategic agreement on a joint venture called Americin, marking a significant strategic milestone for Senores US operations. This partnership enables us into high-barrier US government procurement markets, positioning us to supply our portfolio to the US federal government, veteran affairs, and military programs. Our experienced partners bring expertise in government procurement and liaising will help us leverage specialized credentials for long-term national contracts and FSS tenders. Overall, all the initiatives that we have taken are to strengthen and solidify our US operations, which are more strategic to us. Moving to emerging markets business, emerging market revenue grew by 20% in FY26. EBITDA margin has improved towards low to mid double-digit range. We achieved our highest ever quarterly revenue, EBITDA, and PAT in emerging market business in Q4. Importantly, the business is now cash flow positive, and Q4 EBITDA, which is notably, was 18 to 19%. which we think that will be continued EBITDA percentage for our emerging market business going forward. A shift towards niche molecules, refined go-to-market strategies is driving improvements across key metrics in emerging markets, including better pricing and margins. Overall, emerging market business is demonstrating steady momentum in both growth and profitability. We are also in the process of obtaining fixed approval for our emerging market facility by June, July of this year. This approval will enable us to footprint into key mid-tier markets, some of them in like South Africa, Vietnam, and so on and so forth. Turning to India business, our branded generic business segment continued to build on the strong momentum witnessed over the past few quarters. Revenue for FY26 stood at about 40 crores, growing nearly 5 times from FY25. This growth was driven by expansion of our field force and broader market portfolio, enabling us to strengthen our reach both wider and deeper across India. We have also commenced supplies to several marquee hospitals across the country, providing us with a steady revenue visibility while creating opportunities to deepen engagement and with existing clients and expand our customer base further. On a consolidated basis, we continue to maintain a strong focus on cash flow generation, with an operating cash flows demonstrating a steady upward trajectory. Despite a very high business growth, our EBITDA to operating cash flow conversion has improved meaningfully compared to last year, reflecting enhanced operational efficiency, discipline, working capital management. Our cash flow performance has shown consistent and sustainable improvement, and we remain confident of maintaining and further strengthening this metric going forward. Also, we see a long and promising growth trajectory for Senores and are well positioned to capitalize on the same. With our deep industry experience and extensive experience, we are confident in our ability to continue driving sustainable and profitable growth in years to come. With that, I would like to hand over the call to Mr. Deval Shah, our Chief Financial Officer, to take you through the financial and operational performance. Thank you, and over to you.
Thank you, Swapnil. A warm welcome to everyone on our Q4 and FY26 earnings call. I'd like to take you through our financial and operational performance for the quarter and year ended 31 March 2026. Starting with the quarterly performance, our consolidated income for Q4 of 26 stood at 190 crores, reflecting a strong growth of 66% on the YOY basis, driven by robust growth in regulated markets. Revenue from regulated markets grew by 83% YOY and came to 118 crores. This was driven mainly by product portfolio expansion. Revenue from emerging markets grew by 26% and stood at 20% in Q4 of 2026. India branded generic business doubled on a YOY basis, with the revenue coming to around 9 crores. Consolidated EBITDA for Q4 stood at 62 crores, growing more than 3 times on a YOY basis. EBITDA margin came at 32.7%, improving almost 1151 BPS YOY. Profit after tax and minority interest for the quarter grew by 78% YOY and came to approximately 32 crores. Speaking on the full year performance, consolidated income for FY26 stood at 664 crores, reflecting a strong growth of 62% YOY. Revenue from regulated markets for FY26 stood at 427 crores, growing by 75%. Revenue from emerging markets grew by 20% YOY and stood at 145 crores. Revenue from India branded generic business grew almost 5 in FY26 and stood at around 40 crores. Consolidated EBITDA for 2026 stood at around 200 crores, more than doubling it from FY25. EBITDA margin improved by 527 BPS YOY and stood at 30%. Profit after tax and minority interest for 2026 stood at 122 crores, more than doubling on a YOY basis. We are maintaining a strong focus on cash flow generation. Operating cash flow for 25-26 stands at around 75 crores, showing a significant improvement over last year. To summarize, we have witnessed a strong performance across segments during the year. We have delivered on our guidance of 50% revenue growth and 100% PAT growth for the year FY 2026. We are well positioned to continue healthy momentum and are confident of delivering sustained profitable growth going forward. With this, I would like to open the floor for questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, to join the question queue, you may press star and one. First question is from the line of Tarun Krishna from iThought PMS. Please go ahead.
Thank you for the opportunity. My question is based on our older filings, I find that there was a sourced product segment within the marketed product segment. Can you please comment on how has that evolved over the years?
I think your voice is not clear. You said source product and architect product. What did you say? Tarun, can you repeat your question, please?
Yes, sir. So, based on our older filings, I find that we had a source product segment within the regulated markets. So, can you please comment on how has that segment evolved over the years?
Yes, hi. So, thank you, Tarun, for your question. So this is usually the spot business that has been done. The business has more or less remained consistent, and we don't expect any further growth from that particular business, so to speak. It's all spot business that we are able to do through our network within the US.
Got it. And as of now, how much is that as a percentage of total revenue?
10 to 12%. Got it.
And the next question on the working capital, it has been 114 days as of 2025. As of 2026, it has gone to 187 days. So why has this jump happened, and what do you expect as a steady state?
I think we have the Apnar thing coming in this last quarter. So the working capital has shown that jump, sales has not come in from Apnar. So that has inflated our on paper, which is not so around. If we take out Apnar, it is around 104 days net working capital cycle.
Understood. And going forward, you see Apnar reaching the Concall level working capital days or receivable days?
No, I think we see Apnar sales coming in from next year, this current year now. So it will be at par with our current operating cycle. Nothing different.
Okay, thank you. That is it from my side.
Thank you. Participants, to ask a question, you may press star and one. Next question is from the line of Maitri Sheth from Choice Institutional Equities. Please go ahead.
Hi, congratulations on a great set of numbers. Just two questions from my end. We've mentioned at least 30 ANDA launches. Can you tell me how much of these are expected to be CGT products? And second, on the margin front, margins have come in around 26.5. What kind of margins are we looking at going forward from FY27 onwards? That's all.
Yes, hi, Maitri. Thank you. So exact CGT number would be difficult to demonstrate right now, but quite a bit of product that we have that would qualify for CGT, and some of those products are first to launch, first to market there. We can specifically give you a number what would qualify for CGT in subsequent discussions. That is one. The second is for the margin. I think they're about 100 basis point being suppressed because of the acquisition of Apnar, where we have incurred the expenses over last 3 months, but the subsequent revenue has not come in as of last quarter, which we are already seeing coming in this quarter from April onwards, right? So I feel blended where we have guided 29 to 31% of the EBITDA margin, which we'll probably see in coming quarters as Apnar will start giving us about the revenue that we anticipate. So for the full year, we expect Apnar to give us about 100 crores, 80 to 100 crores of revenues from that particular plant. And that has already started giving us from this last month onwards. So we already made commercial shipments. There have been shipments have already gone to US. As we speak, more shipments are going on. And that will ramp up, will already started from month of April.
Is it okay?
Yes, that helps. Thank you so much.
Thank you.
Thank you. Next question is from the line of Rishikesh Rajesh Shah from Alchemy Capital. Please go ahead.
Hi, am I audible?
Yes,
Yes.
you are. Please go ahead.
Yeah. Good set of numbers, sir. Sir, I had just one question. If you look at our balance sheet, there's one line item, other financial assets. So if you look over the years, this has kept on increasing. Last year it was 116 crores. This year, FY26, it's at 172 crores. And if I look at last year's balance sheet, this figure was actually unbilled revenue. So if you can explain us what this actually means.
Yes, Rishikesh. So Rishikesh, the way the business is structured is, we are in a B2B business wherein goods that we supply are billed at a cost plus margin basis. So we don't realize the complete net pricing of that goods until and unless goods are being sold in the marketplace that we are in. So the part of the revenue, each goods that is being sold is already been considered in our P&L. But however, the goods profit been sold, been categorized as those other assets that you will see on the books. So as we ramp up and as the product gets commercialized, this amount will probably be at some point of time will plateau it and then will start decreasing. But since over last few quarters there have been a lot of launches have happened, that's why you see that amount that has increased from last year to this year. Which you will subsequent quarter, I think it will reach to a level and then it will start coming down as we speak.
Sir, so if you can help me understand, is this the royalty part or what part is this unbilled revenue? So it's very hard to understand and it's going up every quarter.
I think with the new, as he explained, with the new launches,
Yeah.
but when we launch a product, I think as per Ind AS, they have to recognize the revenue and we have recognized it. Right. So my collection, as he said, the profit share will come in gradually. So it is collected. It is nothing to do with warranty. It is not warranty or royalty or nothing like that. There is no warranty.
Okay.
Contractually, the revenue that is due as a profit share is booked as income and it is parked as a financial asset till it is realized.
And usually what is the period between you booking at and when you start getting the money for this? Usually what is the difference?
Typically, it can be anywhere between 1 or 2 months to maximum 6 months.
Okay, got it. Okay, yes. That's all from my side. Thank you, sir.
Thanks.
Thank you. Next question is from the line of Sumit Gupta from Antique Stock Broking. Please go ahead.
Hello, am I audible?
Yes.
Congrats on the great set of numbers, sir. So I have a few questions. So first is, like you mentioned, EBITDA for emerging markets is nearly around 20%. So how should we see the margins going forward over the next 3 to 4 years at least? And what can be the optimal margins in this segment?
Yes. Sumit, thank you for your question. So emerging market, we anticipate next year our projection is about 180 crores of revenue that we are looking to get from emerging markets. As I stated in my opening remarks, last quarter, our EBITDA margin stood at about 18 to 19% on emerging market. As we add another 10, 20 crore, 30, 40 crore of revenue as we move forward, I think the margin will sustain at 18, 19, maybe add another 100, 200 basis points. So can settle at about 20, 21% on EBITDA. So we feel that is the optimum number that next year we can look at emerging market on an EBITDA basis. Probably once we cross about 220 to 50 crores, then we will probably see another 200, 300 basis point jump in emerging market margins. Just to give you a little more perspective, when we started, probably about a year and a half back, our per unit realization on emerging market capacity was about 1 rupee 20 paisa, which we are already about 1 rupee 90 paisa. So you can see there is significant about 60-70% jump realization with the same capacity that we have now on emerging market unit metrics. So which we feel that will continue to improve as we move forward and we get more products. And we have more than 4,000 products under approval, registration approval for emerging market. So that's a significant growth that we also anticipate out of emerging market in quarters to come.
Okay. And next question is Apnar Pharma. So, what kind of revenue and EBITDA we can see over the next 2 to 3 years?
So this year we did about 2.5, 3 crores of revenue last 3 months. It was again we could make only 2 shipments, one to US and one to UK. And this quarter, as we speak, we are expecting revenue to be around 15 to 20 crores, 10 to 20 crores from Apnar facility. And steady state, maybe full year, we are looking at it about 80 to 100 crores as far as Apnar is concerned. In 2 to 3 year time frame, we feel we should be able to do about 180 to 200 crores revenue from the Apnar facility. Of course, it will require a little bit of more expansion on the production suites and so on and so forth. But I think 180 to 200 crores in 2 to 3 years from Apnar is quite visible as we speak in terms of keeping all the products that we are currently making it. There are a lot of site transfer products that are happening and new approvals will come from Apnar plant. So that's something which is visible to us as we speak today.
Yes, so the follow-up on this is the opportunities that you see for Apnar. What is the market size opportunity for this and what exactly will drive this growth?
So market size opportunity just for Apnar will be tough to say, right? I mean, it's across the board. We don't look at Apnar as a separate company, as a separate opportunity. When we look at as a US business Concall, right? That includes our facility in the US, our facility in India, and so on and so forth. So from that standpoint, total accessible market for our own currently approved products for us, it's close to about $1 billion. So with all 51 odd ANDAs that are going to be commercialized in next few quarters, out of which just 20 are there, and there are another 27 ANDAs at a different stage, and there's a CDMO, CMO segment. So if you see going forward as a US business for us in next 2 to 3 years time frame, that's a significant growth that we anticipate. As a company, we are building at least 2,500 to 3,000 crore of revenue just coming out of US in next 3 to 4 years time frame. So everything that we aspire to become about a 3,000 to 4,000 crore revenue from the US as we speak. All efforts are being done, products are being mapped, commercialization are being done. So whether we reach or not, probably in next few quarters will be more visible. But we are putting in all the efforts to reach that kind of revenue number from the US operation. Now that compromises both the Indian operation as well as the US plant, both put together.
Understood, sir. Thank you. All the best.
Thank you.
Thank you. Next question is from the line of Kashish Thakur from Elara Capital. Please go ahead.
Oh, hi, thank you. So, congratulations on the great set of numbers, sir. So I just wanted to ask a question on tax rate. For FY25, our tax rate was somewhere around 17%. In FY26, it's somewhere around 23.6%. Why a drastic jump in this? And going ahead, what can be a normalized tax rate?
The drastic jump is, I think, U.S. taxes and Indian taxes are at 26%, U.S. is at 21%. So since we have started earning in Ratna Trace, there is a tax provision on Ratna Trace, which is being affected. So overall, my 21 to 23% rate is going to be a long-term thing, depending on where I earn. So Indian rate, FPL standalone, is again 26%. So US rates are less than Indian, but since Indian companies have also started earning, the average rate has gone up.
But you can say by
17-18% what you are talking of is because of the old carry forward losses which we had in US, for which the tax provision was not required.
So going ahead, what kind of rate we can expect?
23%, around 23% average.
Understood. So another bookkeeping question. What kind of capex we incurred in FY26 and what we are planning for FY27?
FY26 is around 230 crores, including my acquisition of A&D and everything. I'm talking of
27.
26 I'm talking of.
Okay, actual.
Yes, actual I'm talking of.
Okay.
And can you break that down, sir? How much we have spent towards acquisition of A&D and how much is the maintenance capex?
A&D acquisition is almost 65 crores, 70 crores, 65 crores. Plus the development beyond the acquisition is also taking place on the same molecule.
Mm-hmm.
So that is again a area, but everything taken together, I'm telling you.
Understood, sir. And what will be for FY27?
27 we are expecting around 200 crores taken together.
Understood. And the last question, sir, what has been our growth rate for CDMO business? And I think so we have not disclosed, but what kind of revenue we have done from CDMO?
I think CDMO and own products are almost same, which we continue to do around 50 to 53% of own products and 47-48% of CMO taken together. And we expect it to continue in the same line, 2 or 3% here and there. Yes, our own products will increase this year with the launch of more products what we have acquired.
Understood. Thank you so much.
Thank you. Next question is from the line of Nishita from Sapphire Capital. Please go ahead.
Yes, hello. So I just wanted a clarification on the blended margin that you've given. So on blended basis, we can do EBITDA margin of 29 to 30%. Is that right? In FY27.
Yeah, I think so.
Yes, EBITDA.
Yeah.
It also depends on how you work out your EBITDA, because when we work out our EBITDA, it is taking all operating other income. Get my point? But if you are excluding everything, then 26.5 can become around 28 or 28.5.
Okay. Understood. And on Apnar, you mentioned that we can do revenue of 100 crores in FY27, right?
Yeah.
Yeah, 80 to 100 crores is what we have budgeted for the year.
Okay. Understood. Thank you so much.
Thank you. Next question is from the line of Forum Parekh from BOB Capital. Please go ahead.
Thank you for the opportunity. My first question is on our IPO fund. So we almost have 100 crores of unutilized fund. So if you can just help us understand, do we plan to utilize this fund in the near term towards any more acquisition or any such things?
Yes, Forum. So that 100 odd crores of IPO fund is for a specific purpose that has already been given in our DRHP. So we plan to start the operations for that particular purpose within this year. So I think part of it will be utilized this year, subsequently going forward for next couple of years in terms of the development of our sterile manufacturing.
Okay. And my second question is on this regulated business, U.S. business. So we have given a guidance of almost U.S. Regulated business reaching 3,000 to 4,000 or 2,500 to 3,000 crores. So if you can just help us understand like how much would be from organic and inorganic activities, since we have done so many inorganic activities.
Yes. So what we anticipate in terms of the 51 ANDAs that we have currently approved and that 27 more products coming in, the accessible market for opportunity for us can be of the number that we have spoken about in next 3 to 5 years time frame. In terms of organic, inorganic, I think it will be very difficult to pinpoint in terms of what could be the organic and inorganic. For us, everything becomes organic because not necessarily the product that is acquired is immediately been launched, right? There are a lot of modifications happens on the products. There are differentiated strategies being worked out on individual products that has been acquired. So there are a lot of things, there are a lot of development over and above the acquisition that happens, right? So for us, everything is organic, and that is our strategy, and we'll continue to demonstrate and derive that strategy going forward.
Okay. And my third question is on the branded business. So if you can help us understand how many field force we have currently and what's the strategy there, like within 5 years time frame, how big can we expect this business to scale up to, and do we intend to add more MRs?
Yes, definitely. We have already increased our MR capacity, MR count from last year to this year significantly. We had about 120 to 130 people today on the field as we speak. We are already approved in a lot of marquee hospitals as we've spoken about. That will continue to drive our further growth. So this year we have budgeted about 60 to 70 crore of branded generic business in India. I mean, we could still do better, but this is what we have budgeted so far. That will probably require us to hire some more field force, some more MRs in different parts of India. But this branded generics for the business that we operate in is a little different from typically how the branded generics that exist in India. So not necessarily we need to hire a lot more field force to kind of scale up the business. So we'll definitely hire, but to relatively to the lesser number as we speak.
So would you be comfortable giving this the quantum of MRs that we intend to plateau at, or we need to have at least?
Yeah, about 200. Yeah, if you have to put a number to it. So I think at a 200 we will try and kind of consolidate on that side.
Okay, that's helpful. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the question queue, please restrict yourself to 2 questions only. Should you have a follow-up question, please rejoin the queue. Next question is from the line of Gaurav Tinani from Ambit Capital. Please go ahead.
Yeah, hi, thank you. So, sir, just on your guidance, you guided for a 30 to 40% kind of growth on the revenue and 50 to 60% on the profitability. So, you've already done, 30% kind of margin in FY26, and you're guiding for margins to stay at the same levels next year. So then with a 40% revenue CAGR, how does the 50 to 60% profitability, is that PAT or is that EBITDA that you are guiding for?
Yes, hi, Gaurav, thank you for your question. So there are, as you know, there are a lot of moving parts, right, in terms of currently in scenario. So margin is in effect of multiple things that prevails. Our aim is to grow our margin from what we have guided for, not necessary every time because of the uncertainties that we're currently living in will probably result into something like that. If you historically see, we've grown our operations by 60-odd% on the revenue and 100+% on the profitability PAT side. So keeping the same metrics in place, if you ask me, will be able to 30-40% on the revenue, to 50-60% on the PAT, doable because that we have demonstrated so far over last couple of years. However, from a margin standpoint, blended margin, I think we are comfortable picking at about 29-31% that we have spoken about on the EBITDA basis. So I think currently we would not want to change our EBITDA blended guidance for the next year. But if we are able to do, and there's a geopolitical and macroeconomic factors turn favorable, of course that can further improve. But at this point of time, do you think our margins to improve on this? I think we don't want to guide it. Don't want to guide more than that 29-31% that we have been talking about on the EBITDA basis.
Perfect. So, looking at your guidance a little differently, so 30-40% top line growth, I'm assuming, includes 100 crores from Apnar as well. So,
Yes.
So then, X of Apnar are only guiding for, something closer to 20-25% growth on your rest of the business. And this is with, your CDMO business also growing, your own ANDA launches to gather pace from here. So isn't it, if you've been growing at 60% now with Apnar, you're guiding for 40 and, without Apnar for 25. And your product mix is also changing and, so it's a little difficult to comprehend, why you're being so conservative or maybe, we are.
So Gaurav, this is Sanjay here. What we want to convey is that this is the minimum 30-35%, 40% top line is the range we are giving for 3 reasons. As we speak, there are a lot of moving parts in terms of external environment, which is not very conducive. Shipping lines, everything, overall atmosphere, even in US in terms of inflationary pressures, etc. So we have decided to be a little conservative. Let us wait for 1 or 2 quarters. Let us see how things settle in the world. In today's scenario, to talk of a 35% growth itself is a very courageous thing, I would say. But I think we have a lot of visibility to at least say that this could be regarded as minimum achievable. Let us wait for a couple of, at least 1 or 2 quarters, and then we will see whether we need to revise the guidance. Let's go with this number for now.
Okay, sir. And I think the second question from my end would be, you've generated OCS now in FY26. FY27, I didn't get the capex number you've been guiding for, and do you see, what kind of, it can be the first year we generate FCF also?
Free cash flow, let's see. Currently, the guidance is that out of the current year's capex, we have about 100 crores funds available from IPO. Correct. So I think we should generate free cash flow in 26-27.
But what would be the capex number for FY27? Maintenance and growth combined?
Sab milake 200 crore, which includes that 100 crore for injectable and balance 100 for various other plants plus maintenance capex, etc.
Okay, 100 crores IPO proceeds and 100 crores from our own. Okay.
That's right.
I'll join back with you. Thank you.
Thank you, Gaurav.
Thank you. Next question is from the line of Sujal Janwar from Opportune Wealth Advisors Private Limited. Please go ahead.
Hi, am I audible?
Yes.
So, sir, I want to ask about this JV which you had within the US. So, how much able to you will get the better margins on the PET side with the help of this JV? Can you give me the kind of guidance on that part side?
No, you mean to say the new JV?
Yeah, from the JV you did in the US business, how much there will be incremental margins you will be able to make with the help of JV?
No, we will go with the overall guidance that includes whatever we have internally calculated from within the new JVs that are happening.
Okay, sir. And my second question on the part of, sir, is are you able to see any product mix change between regulated, emerging and branded generics in upcoming 3 to 5 years, like branded becoming the more business, becoming more business than emerging markets?
So all segment business, you see, are in the growth stage, right? I mean, each segment that we operate in are growing at a fast pace. Changing the product mix, yeah, of course, emerging market, we already spoken about that new products are getting approved, which are higher margin, first to file, first to launch kind of opportunity. Even in US, there are a lot of CGT kind of opportunities, first to launch kind of opportunities. So of course, as we move forward, the lucrativeness of product may come in, which will probably represent the larger share as we speak. What percentage it will change going into granularity will be a little tough to kind of point out at this point of time. We'll adjust it at a later date, if there is any significant change on that side.
Okay, sir. Thank you. That's so much.
Thank you, Sujal.
Thank you. Next question is from the line of Rachel Maheshwari from Naredi Investments. Please go ahead.
Hey, am I audible?
Yes, please go ahead.
Yeah. Hi, congratulations on the set of numbers. I just had a few questions. First is, can you repeat your FY27 emerging markets revenue? How much was it?
FY27, what you said? Revenue?
Yeah. What are we
Emerging is
projecting?
about 180 crores.
Okay. And sir, earlier we were talking about an facility in Atlanta, an OSD facility that was coming up in US. Is this still coming or?
So OSD is already there, right? We've been operating that facility for almost a decade now.
No, I think we were putting two more lines there. So.
Yeah. So we have currently commercialized 3 lines. Fourth line was to be commercialized or was to be installed, but we have pushed that plan because we acquired Apnar in month of December 2025. So we will get utilization of both the facilities to a level that we would be comfortable in. Then we'll probably see whether we want to install a 4th line in the US or maybe expand lines at our Apnar facility in Baroda. So I think probably in the next 2 quarters, we'll have more clarity in terms of where that expansion will be followed through. So 4th line is currently being pushed to a later date as we speak.
Okay. And sir, I had one more question. That is, what is the thought process behind moving towards, front-end sales and marketing in the US?
I would like to be brief about it. So, yeah, there are a lot of acquisition of products that we have done, and those acquisitions are largely an approved product. So for us to access the market relatively is quicker than doing a completely new development of a product, right? So the idea is to get access to market quickly with our own front-end presence. That kind of helps us create our visibility and the marketing presence, on those acquisition approved ANDAs. Cash-wise, the cash requirement to launch those already approved products is significantly lower than developing a new product and then going into market with your own marketing presence. So overall, we looked at a differentiated strategy. We compared and we thought this will be a right strategy for us, specifically for an acquisition portfolio to go out and launch our own front-end presence. So largely, currently our front-end presence, our own marketing, our own sales and marketing distribution company is through our acquisition portfolio.
Right. Thank you so much. Those were my questions.
Thank you. Next question is from the line of Smith Doshi from Oaken Capital. Please go ahead.
Yeah. Am I audible?
Yeah.
Yeah. So I have two questions. First is on the forex gain part. In emerging market, we have
Mr. Smith, are you on a speakerphone? Request you to please use your handset, sir.
Yeah, I have two questions. First is with regards to forex gain. In our emerging market portfolio, we have done around 20% kind of EBITDA margin, compared to earlier quarter three of 13%. So how much would be due to forex kind of movement, and how much is due to operational efficiency, like what sir said, that 1.2 rupees to 1.9 rupees per unit? That is first question. And second question is with regards to the earlier participant question with regard to other financial assets. So if you can elaborate that answer, that 172 crore rupees of other financial assets with example of, let's say, 100 rupees of sales, then it would be very helpful for the overall audience to understand.
I think to Smith, to answer your first question, whatever in emerging market, whatever you have seen the improvement in margins are mainly due to the product change, what we have achieved. So the forex, due to forex, yes, but these are all realized forex gains because you received the realization on the sales. So yes, there is partly it is due to the exchange rate increase, I'll say, but still.
It's about 3 crores.
3 crores.
Emerging markets around 3 crores. Due to that forex favorable movement effect
during the year.
Okay.
Yeah.
Right.
Okay.
I think on the second question, Smith, see, giving examples, etc., what we would suggest is let's take this offline with Deval tomorrow or any other day and he will explain to you.
Okay, no issue. Thank you.
Thank you. Next question is from the line of Divyam Doshi from 923 Capital. Please go ahead.
Congratulations, sir, on the good set of numbers. I just wanted to ask you that we have 51 ANDAs right now, out of which 21 are launched and 30 are not launched. So can you give me a expected timeline when you are going to launch these?
Yes. Thank you, Divyam. So we expect complete rollout of remaining products in next about 6 to 8 quarters, the remaining approved ANDAs. It's an ongoing strategy, right? So we'll acquire probably a few more strategically in quarters to come. So we feel that this trajectory, this strategy for us is going to continue. But if we stick specifically of this 51, I think in another 6 to 8 quarters, we should have at least 90 to 95% of 51 is to be commercialized.
Okay, so thank you. And what would be the average revenue or ANDA could generate?
Very tough to comment on this at this point of time. We'll come back, right, in terms of you can have a specific question and we can answer that.
No, but just to add, you see, all these launches will not immediately give peak revenue. Peak revenue takes 3 to 5 years or at least 2 to 3 years for the product to reach. But from a TAM perspective, Swapnil has already given you an indication. So, yeah, it's a fairly decent expectation over the next 3 to 5 years.
Okay, sir, I get that. Thank you so much. And one last question, that the US JV, that is Amerigen, what the target is basically revenue, right? Because that are government contracts, so the margins will be very thin, right?
No. You're talking about Amerigen, right? Particularly?
Yes, sir. Particularly Amerigen.
Margins are not very thin. I mean, it's a different vertical of business that's out there. We feel this year probably we'll do about 80 to 100 crores of revenue from that JV, or maybe little conservatively, maybe 50 to 70 crores. That's what is been budgeted between, say, 70, 80 odd crores, right, on an average basis. We feel we'll be able to achieve that with a decent profitability which will be almost an average of what our US EBITDA business is, which is about upwards to about 40%. So I think that is within that, the guidance, within the framework that we have for US business.
Okay, sir. Yeah, I get that. Thank you so much, and all the best.
Thanks.
Thank you. Ladies and gentlemen, due to time constraint, we will take this as the last question for the day. I now hand the conference over to the management for the closing comments.
I would like to once again thank you everyone for joining our earnings call. We will keep updating the investor community on regular basis of the developments at Senores. I hope we have been able to address all your queries. For any further information, kindly get in touch with us directly or through our investor relations partner. Thank you once again.
Thank you and have a good evening.
Thank you.
Thank you, sir. On behalf of Ambit Capital, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.